Good afternoon, ladies and gentlemen. Good afternoon specifically to our clients and to intermediaries who's joined us in this afternoon's presentation. A warm welcome to everybody. This afternoon, we tackle quite an interesting investment topic. We're going to discuss the merits of investing in listed property. And in order to help us to come to an answer, we are very privileged to have one of the doyens of the industry in South Africa, Estienne de Klerk, who is currently the CEO of Growthpoint, the biggest listed REIT in South Africa. So welcome, Estienne. It is really a privilege to have you here this afternoon. Maybe just one or two things about Estienne. As I said, he is the CEO. He's always taken a leadership position within the industry. And at the moment, he is heading up the REIT industry in South Africa. But when I looked through his CV, when I looked at his academic qualifications, I thought they were one or two interesting things. He was probably a student like I was. When he qualified as BCom, I saw it was industrial psychology. So the lazy guys did industrial psychology. Then he did an honors in marketing, so it was a step up, and suddenly he became a CA. So at least you saw the light. So welcome, Estienne. We are absolutely delighted to have him here because what I would like to share with you this afternoon is just a few slides on the property sector, and I would like to show you that it is indeed a cyclical sector. So there's sometimes where you want full exposure to the sector and sometimes where you don't. So once I've done the slides, I'm going to pass over to Estienne that will talk to us about the industry and about the company. And then to add a bit more granularity to the discussion, we have our senior analyst, investment analyst, Dave Lurkey, and Dave will post a few questions to Estienne in the conversation. And then finally, on the Zoom meeting, you are most welcome to post questions. I will see it on my computer here. And to conclude the conversation, I will post those questions to the panel. And of course, if you have them, if you have some questions for me, I will gladly answer them. So to start with the presentation, I've only got three very simple slides that I would like to share with you. And those slides really touches on our investment philosophy as well. The first point is if you look at the SA Listed Property Index. So that is simply just a slide that shows you the price performance of the listed property index. And it goes back to March 2002. And you will see that I've indexed it to 100. And since March 2002 until about the first quarter in 2018, you can see that that index went from 100 to 700. So the capital growth was sevenfold over about 16 years. And it was absolutely a phenomenal investment to have. What you can see, however, is if you cast your eye to the right of that slide, that index dropped from 700 points to about 250. So that takes you back all the way back to the levels of about September 2005. So all the capital, not the income, but all the capital takes you back to a level about 15 years ago. And that is how brutal the market can be if things can go wrong and if sentiment changes from being overly optimistic to perhaps overly pessimistic, and I'm sure Estienne will discuss that with us. If you look at the next slide, you should ask the question, so why did this investment do so well? And the answer is quite simple. In this case, I've just drawn a slide where I show what has happened to the distributions or the dividends of the sector. And again, you can see that the trend is very clear if you look at this slide that since March 2004, the dividends or the distributions grew substantially over that period. And you had the capital reward because the market felt comfortable with this investment because it produced the income that was required. However, if you look at the scale, it's a bit different. The capital went up sevenfold, and in this case, the distributions over this period grew by 180%. So there was a serious re-rating in the sector, and in simple English, it simply means that the sector went from being very cheap in the early 2000s to, in the way that we would describe it, expensive later from 2015 onwards. And if you look at this graph towards the end, you can see the impact on COVID in terms of the distributions. As you can see, the distributions came under pressure in that last data point that we see there. And the reason why I show the Growthpoint dividend yield is simply because we've got decent longer-term data on the share. And I want to take you back to the late 90s, early 2000s. That was the time when interest rates were very high in South Africa. People were very skeptical about the economic outlook in South Africa. And it was also the time when emerging market currencies came under pressure when the Russians defaulted on their debt back in '98. So the sentiment was extremely negative when it came to banks and when it came to listed property companies. And you could have bought this share with a dividend yield of 20% back in May 2002. Now, the yield looked very attractive, but the story associated with the yield was very negative. Fast forward 18 years, and we are more or less at the same point. The historic dividend yield, earlier this year, 18%. The story, a very negative story. Many people describe South Africa as cheap and nasty. That is an example where the market thinks that South Africa is nasty and the asset prices reflect that. I would like to pause there, but before I pass over to Estienne, I would just like to also make the point, if you look at the re-rating in the sector and you look at that period from essentially 2013 to about 2016, you can see that the yields dropped to levels of below 6%. At that time, as a house, we felt that despite the fact that there was a lot of excitement about property, that we need to reduce our exposure to listed property, not because we necessarily felt that the sector or the companies were badly managed. We simply felt that a lot of the good news was priced into these shares and it was time to lighten your exposure. So as we sit now in our multi-asset portfolios, we've got about 2.5% exposure to the sector. And I think, Estienne, the question is, despite the nasty story, do you think that those yields are attractive enough to make an investment in this particular story at this point in time? Thank you very much for joining us.
Oh, thank you, Alvain. Thank you, Dave. Thanks for the invite, folks. Sanlam Private Wealth, for the opportunity. Clearly, it's not the 7 fat years in real estate at the moment. And in fact, I was on a road show a couple of years ago. It was just before Steinhoff. I shouldn't use that word, but we were trying to raise a bit of debt, and there was this Swiss chap that looked at, and we did our whole presentation, and he looked at it, he said, you're a pretty girl in an ugly neighborhood. And I think what does happen from time to time is that, the market is complex. It's not always efficient. And I think real estate in this environment, certainly if you look at what's happened on the bourse, it's certainly taken a huge amount of pain, and there's not a lot of love for it at the moment. So, if everybody is thinking the same way, my view is always somebody's not thinking, and I do believe that there certainly is some value to be had. Why do I think that? So I think firstly, the yield environment that we are in, clearly globally, if you invest in bonds, you actually have to chip in certain areas. If you've got cash in a euro account, bizarrely, you have to pay the bank to keep it for you. So, if you think about just real estate as a global sort of player and an investment class, you've got equities, you've got bonds and cash, and real estate really is pretty diversified away from those sectors. So we certainly, as a industry, believe that real estate should always form part of any investment or proper investment portfolio. if you look at what the dynamics are in the world today, clearly there are quite a few headwinds, not going the way of real estate. And I do think that some of those factors, have led to what we are seeing here. If you look back and you referred to the early 2000s there, fundamentally, the fundamentals were poor. You had huge vacancies. I got involved in a little fund called Growthpoint Properties, which we were managing, and vacancies were over 15% in this industrial property business. And distributions were actually not growing at all. They were negative, and in fact, a really great performance was maybe like a 1 or 2% growth rate. So, these cycles do go through, and that's what we're seeing at the moment in the listed spaces, that distributions have arrested in terms of growth. So, many of the real estate companies, and I think clearly COVID has had a massive impact on the industry, and we can maybe touch on that a little bit later as well. But if you look at just generally across the market, for the past, say, 9 years, the economy has taken strain in South Africa, and as a result, you have seen that the listed property companies have not really grown materially in terms of their value. You've also seen long bond yields, and there is quite a correlation between the listed real estate space and long bond yields. And because long bond yields sort of ticked up, we also saw that, the Growthpoint share price, if you drew a graph of that, you'd see there was a period for nearly 5, 6, 7 years where in fact the share price went nowhere, and then clearly into COVID it's literally halved. That hasn't been a great experience. If you've worked on a business for 20 odd years and your share price halves, and a lot of it hasn't got anything to do with management's input, that's a tad disappointing. So, from our point of view, we'd obviously like to reverse that. And I think there certainly is a whole bunch of things why real estate potentially over the long term probably will do better than what the market is reflecting now. So I think if you look at the market at this point, clearly all the bad news is into the share prices. You've got weak fundamentals, a very weak economy. So the biggest single factor with real estate today is in fact the weak economy. So that has an impact on demand. Overlay COVID on top of that, and you've got a absolute nightmare. So in my career, I've never had to deal with, from an operational management perspective, a situation like we had in March, where literally government closes a big component, our whole retail business gets closed down, right? And it costs you money because you clearly have expenses, rates and taxes, your bonds on your properties, all those things remain in place. And at the same time, you've got a client base that all of a sudden says, well, look, guys, sorry, we closed, we can't operate, and we're not going to pay or can't pay, So the industry, we pulled the industry together reasonably quickly, and I think as a country, we've done pretty well to work through that reasonably fast. It was quite painful from our perspective in that, at Growthpoint specifically, in 3 months, our distribution lost more than R1 billion. So we went down from gross 6.4 billion, and our year-end number was 5.4 billion. So it gives you an idea, we didn't go unscathed through this process, but relative to many of our peers, we've actually done very, very well, and that talks to the diversification of the business. And each one of the sectors has their own unique sort of trends, and those aren't necessarily correlated. So yes, the economy has an impact on all the sectors, and we as Growthpoint have invested in quite a broad range of sectors, retail, office, industrial. We've even got hospital exposure. We've got a hospital fund that's actually performed very, very well in this time. So there are definitely sectors that aren't as correlated, but COVID really had a bad impact on not only on our business, but certainly on the sector. I think on top of that, what we're seeing in the market is that the market is pricing in huge risk very, very poor fundamentals, and also big capital raises. So I think what the market is looking at some of the companies and saying, you know, they're looking at deep discounted rights issues like what we saw internationally and globally in 2008, 2009 for real estate companies that were exposed to the global financial crisis. Now, interestingly enough, we made some of our best investments like into Australia in 2009, right in the eye of the global financial crisis. In fact, South Africa pretty much chose to ignore the global financial crisis, to be honest. I think there was a whole bunch of reasons for that. Certainly exchange control contributed a little bit, but you know, South Africa had always, its real estate space was quite conservatively managed and conservatively geared. And through that time, even though the economy took a bit of a dip, you know, I think the World Cup and some of the capital spend from government helped us see through that time. If we look at the current situation, you know, our economy is pretty poor. Demand is pretty weak. It has played out in retail, office, and industrial. There is oversupply in each one of those sectors. But if you should get a bit of economic growth, you know, certainly the sector will hugely benefit from that. And I do think that if you look at those yields relative to what you can get in cash at the moment, and even in some of the bonds, and I mean, bonds are a bit of an anomaly in that, you know, the South African government doesn't seem to have or has an insatiable appetite to borrow money at this stage for all sorts of things, as we all know, and that has sort of ensured that bond yields remain pretty high. So I think that has had quite an impact on the yield environment for listed property. And what we are seeing is that I think that relative to global yields, I think that you know, our yields are probably disproportionately high. On top of that, the expectation of these big capital raises, I think, has put a lot of negative sentiment. And in the end of the day, a lot of South Africa's share price values, fundamentals are important, but it's all about flows, capital flows. I mean, increasingly we're seeing that, you know, our second largest shareholder today is a passive fund. So these are computers that either buy you or sell you. And if you're in an index, then you get bought to a certain level, and that's indiscriminately the case. So what we are seeing is that, you know, there's been quite a bit of capital flowing out of South Africa. Unfortunately, it's actually very sad. But you know, should that reverse, and it can on a ticky reverse, then you see a big strengthening in the rand and in the counters, and that can also have quite a counter cyclical sort of scenario to what we're seeing now. If we quickly run through the sectors, if we've got a bit of time, I mean, retail, you know, I think we've saw over the years quite a lot of expansion of big malls in South Africa, and that has led to a bit of oversupply. Ironically, that was driven by the retailers themselves committing to every guy with 2 bricks and the rights to build retail. And I think that movie is over, to be honest. I do think that, interestingly enough, what we have seen with COVID is that you know, footfalls have dropped initially extremely, clearly in a lockdown scenario. But as we've moved through it, people quickly came back to the shopping centres, but they're not coming as often, right? But when they're there, they're spending much more than they used to, and they're spending slightly in a different way. So people, because I think there are more people at home, there's a bigger spend to home goods and more to leisure and athletic wear from a clothes perspective, and maybe less suits and ties being sold this year. So you know, you can see that in the spend across the retail space. I think from an investment perspective, you know, these assets are big assets. They do require significant capital to maintain them, to keep them attractive for not only the tenants in there, being the retailers themselves, but actually the shoppers. So, you know, the shoppers want to go to a nice environment where they feel safe, where it's comfortable, and where they have a good offering. And I think to maintain that, you know, for the real estate owner, you know, that requires quite a bit of investment into those assets on an ongoing basis. And capital is quite expensive and quite tight for the sector in this specific area. So I do think that, you know, there's a big amount of capital that's actually looking to move away globally out of retail. And when we look at the global perspective, I think the worst must be the UK, where we've got a government-endorsed rental strike, and there we've seen valuations just absolutely tumble in retail. There is the theme of online. I think we'll touch on that a little bit later, and we, some of these themes are maybe overplayed, certainly in the South African context, and we don't see that the shopping centre disappears as we know it today in South Africa. Moving on to office. Now, clearly there, you've once again got a sort of a theme playing out, because everybody, or many people, have to work from home at the moment, given the sort of COVID scenario. But we don't see that as a long-term theme. And I think what we've seen there is the economy has had a much bigger impact on office over the past 5 years than any of these other short-term factors, be it collaborative workspace or any other concept. Excuse me. If we look at the industrial side of things, interestingly, that sector seems to be defying gravity in many respects. And even though there's weakness in retail, we're certainly seeing a lot of money flowing into industrial, and that is definitely a factor that doesn't always justify the investment, but the themes, the big investment themes there are playing out in that sector, and clearly there is a big growth in that space. So that sector of the three sectors has really performed the best. Then I'd like to touch on healthcare. It is a bit of a passion of ours at the moment. We've got a small fund that we've raised, and it invests in healthcare assets, hospitals, etc. And interestingly enough, because of the long leases in the sector, it really has performed very, very strongly, and there's good demand from the operators to expand their footprint in a country that needs additional healthcare space. So we are seeing quite strong growth in that specific area, and it's pretty niche. So that's not really available on the listed sector at this stage, but certainly we believe there's an area of growth there. And then other sectors like student accommodation and telecoms infrastructure, we do see that will be a strong area over the long term in our country. There are other big challenges. Rates and taxes, I've mentioned to you gentlemen earlier today. Our municipalities unfortunately have an insatiable appetite to collect rates and taxes and money for utilities, etc. And unfortunately, their ability to deliver services isn't correlated to the amount of money they're collecting. So if you take over the past 10 years, we've seen those rates and taxes in the commercial sector grow compounded at 10.5% per year. Now, that's not really sustainable for the sector. So we're taking a bit of margin squeeze in that space, because ultimately it impacts our ability to collect rental from tenants that only have a certain ability to pay sort of a cost of occupation for their businesses. So that is a bit of a threat. What has been a good thing is it's driven quite a good behavior in the sector, that we've seen a very strong growth in the sustainability and green building initiatives across the sector. And that's bringing down the cost of occupation for our clients and for the tenants, but it's also doing the right thing in the actual bricks and mortar. So the technologies that are going into buildings is much improved. And today, most large real estate companies generate quite a lot of money in terms of solar power on their roofs. In fact, I would argue if it wasn't for the limiting structures that Eskom have in place and the regulations around electricity generation, I think the sector would have come to the party significantly as a power producer, certainly for their own properties. But we're very hamstrung in what we are able to do from that perspective. But that I certainly see as a theme going forward. And, it's broader than just electricity. It's water supply. It's all sorts of other social aspects that the real estate industry increasingly are getting involved in. So I think those are all really, really good aspects that need to be taken into account. I mean, in the big picture, there's some good news and there's some bad news. So the bad news I've mentioned mainly. On the good news side, low interest rates, it's a great thing for real estate, and that will hopefully see the economy move forward. Growthpoint, we've done very, very well in the mining sector. We've managed to secure some really, really top-class clients, Exaro, Anglo, into brand new buildings. So that sector is really cranking, pumping, and in that space we've been able to do some nice business for that sector. So those are good things, and I think ultimately the mining sector will flow through into the economy over time. It's not as a material contributor as it used to be, but certainly will impact us. And I do hope that if the global economy picks up a little bit, that will certainly play out into the South African economy, which will support listed real estate, broadly speaking. And I think the governance processes, SA REIT, I chair, as you mentioned, SA REIT Association, and we've spent a disproportionate amount of time bringing out new reporting frameworks, which our members will hopefully follow, and that will lead to significantly better transparency. And I do think that, it'll make it a simpler sector to analyze for Dave and all his friends, and hopefully that additional transparency will lead to more investors seeing the value in the sector. Thanks, Dave.
All right, yeah, Estienne, I've got some questions for you here. Maybe just to start with, I think probably one of the biggest questions on people's minds is, so COVID has clearly changed the way we do certain things and accelerated a lot of processes that may have taken a decade, have now taken 6 months. Can you just take us through your thoughts around both how COVID has changed the retail environment on a sort of 5-10 year view, as well as the office environment, also on quite a long-term view, sort of how it's structurally changed the way we look at property?
Yeah. Look, I mean, I think there's, so maybe let's start with retail, Dave. I mean, clearly the theme internationally in the developed markets speaks around, the online shopping trend. And really in different jurisdictions, it's playing out differently. And I if I had a wonderful crystal ball, I would have polished it and given you an exact answer. But truth be told, none of us really know. So what I can say is that in researching the extremes, so let's say the US and the UK, what we've seen is that online has sort of topped out. And let's take COVID a little bit out of it for now, because that has led to, let's call it a disproportionate sort of scenario, in that if you can't physically go to a store, then, what alternative do you have, So I think the reality is if we look at the trends, in the UK, online topped out at about 26% of total retail. Now, that statistic in South Africa is only about 1.8% a year ago, comparable. And the latest statistic we've had is that statistic has gone up to about 5.5%. Now, usually the 1.8 was, half of it was services, buying airplane tickets and movie tickets, all those kind of things. It wasn't actually real retail. I think in the past couple of months, we've seen a big tick up in online of goods, and specifically groceries. I think all the grocers and the store, the retailers have a solution in terms of online today, but it's predominantly servicing the sophisticated middle-aged market, and not necessarily all the retail clients in the sector. So we've seen, with people being forced to their homes and to their different regions, their second homes, that there's actually been a bit of a skew in trade. And in fact, rural retail has actually performed superbly, in this time. And and of course, if you add extra grant money to that movie, it certainly boosted rural retail. So the whole retail theme, I think, isn't consistent, and investors have to take that into account. I mean, certain of our regional shopping centers in metropolitan areas, in the neighborhoods, have actually gone back to 100% reasonably quickly. On average, across our portfolio, the number on footfall is at about between 75 and 80 odd %. And what we are seeing is people are going less, but they are spending basket size much more. So we do see that, ultimately the retail probably will circle back to somewhere in normality. The South African challenge is maybe a little bit of oversupply of retail. You'll have, for the folks here down in Cape Town, I mean, just in the Milnerton area, there was a brand new shopping centre being built. But Checkers, for instance, would have 4 or 5 outlets in that 4 or 5 kilometre radius, which is really bizarre, So I think some of that action will probably consolidate in the retail space. And I don't believe that online in South Africa, given the logistic challenges that we have and the expense of providing those logistics, will be a consistent, it will be a consistent theme that I think that normal retail will probably survive. I think online will grow as things develop, and I think maybe real estate can actually play a bit of a role. If you've got 440 properties like Growthpoint has across the country, that in itself must be an opportunity. And most of the online service providers at this point, even though their turnovers have gone up, they're still making losses, because as soon as you return something, then all of a sudden that sale is a loss. I think if we move on to office, this one is the most difficult, because what we have seen is that vacancy factors in office had already been ticking up for the past 5 years. And the reason is corporate South Africa has shrunk, right? And the economy's been under pressure, and that hasn't really played into the real estate space. And continuously, there's still a demand for quality, top-end office. So you're still seeing development, as bizarre as that may seem, So we recently completed a 35,000 square meter office in Rosebank. And that building is fully let. In fact, some of those tenants wanted the whole building. And, we would have been able to let more if we had more space in that building. And we have the odd corporate client, as I mentioned, the mining sector specifically. Those guys needed upgraded new technology in their buildings. And green buildings, healthy buildings with new technology and the latest sort of efficiencies is certainly, there's still good demand for that. Oversupply, there definitely is. I think if you're in the B and C sort of grade space, the weaker, smaller offices in poorer areas, older offices, I think many of those buildings might have a very limited lifespan, because they are uncompetitive from a cost perspective. So they don't have the new technology in, and unfortunately that really limits their life in this kind of economy. I do also believe that, if you look at things like collaborative workspace, which was a big growth area, COVID has put a bit of a handbrake on some of that activity. And it was something that, Growthpoint also got involved in, and there is a need for that. And I think it'll be an amenity like a restaurant. And I think that's another theme that we're seeing, is that people want to be able to come to work, and that is still a requirement. People want to come to work. There are a lot of things that you can't do at home. If you've worked in front of your PC like many people have over the past 6 months, it's not really a great experience, to be honest. You want those little breakaways with your colleagues to be able to discuss creative ideas. If you've got young staff or any staff starting at your office, it's very difficult to mentor those staff on a remote basis. And I do think that it also depends. In the South African context, we always talking from our perspective, but there's a broad component of our community that doesn't live in an environment where they've got good connectivity, where they have a sort of residential setup where they can functionally work. So those people really do want to come to work. They like the air conditioning. They like the community that offers. And for us as the real estate players, we're going to have to step up and provide more of a service, more amenities. And I think those are the themes that will be coming through office.
All right. Estienne, maybe just sort of taking a slightly different angle for a moment, more from the the sort of financial valuation side of your business. We've seen, you mentioned earlier, Growthpoint trading at a substantial discount to your net asset value, as you publish in your books, which has led a lot of people to question whether that net asset value is actually the truth. Can you maybe just sort of give us a little bit of background about why we should or shouldn't believe the net asset value that you put out when you publish your financials?
Sure. So maybe just give you a bit of insight into the governance around maybe the valuation process. So we have roughly, and this is in all our subsidiaries, whether they're local or global, there's a process that gets followed. All the properties are valued annually, either externally or internally. And I mean, we've got a whole division of valuers looking after the process as well as the actual valuations. So those are valued, and they valued based off actual real information. So these are leases that are in place, or if there's vacancies, there's certain assumptions that are made, and those valuations are then based off the market dynamics at the time, at that point, being, let's say, year end as an example. Most of our valuations are performed by external sworn valuers, and they work totally independently. So they will give them the information, the budgets for the properties, all the dynamics, and they make their own assumptions in terms of vacancy periods, in terms of what the rental should be, or if it's over market or under market, and ultimately they produce the valuation of what they believe the values are in the market that we could sell those properties at. Now, the reality is in South Africa, some of those valuations are a little bit more theoretical, in that liquidity in this market has dried up to a large extent. So the banks are very hesitant to provide funding to investors in the physical property space, and many investors, with what's happened to the property market, has seen a lot of their equity wiped out, and as such there's a little bit of a shortage of capital at this point. And because of the uncertainty, you're not seeing a lot of new capital flowing into the sector. So there are not that many data points, which is maybe where some of this uncertainty then emanates from. But what I can guarantee investors is that the valuations that the board of Growthpoint put out, they are the best view of what those properties market value at the time is. And the market might take a view that next year they are lower, right? But the purpose of those valuations are to say, what is the value now? So, and equally with a share price, if you're doing a mark-to-market valuation, you take a data point at a point in time, and that's what the value is. Ultimately, these valuations are underpinned by what? It's underpinned by the rental, by the growth in that rental, or the negative growth, if that is the factor. And then clearly the long bond yields, or the yield environment, has a big implication on those valuations. And most of these valuations, all our valuations are done on 10-year DCFs on a sort of very sophisticated system that's integrated into our enterprise system, and all the valuers use the data which they verify off the leases, etc. So the process is pretty thorough, and I would suggest that for the bulk of the REITs in the sector, I would suggest they probably follow exactly the same process. And those properties are also rotated, so it's not like we're giving the same property to the same guy every year. We do rotate that. So I think from a valuation aspect, I can understand the concern, because that would be the obvious sort of fallback position. And the reality is when the stocks are being traded, they obviously taking into account much more things than the pure underpin of the value of all these assets. And I do think that, these companies, albeit consistent of a whole bunch of properties, they generally probably have more value than the collection of the properties, because it's a proper business, right? And it's got a brand and things that are valued in IT at multiples of turnover, So there is a component that is taken into account. And I mean, there's aspects on the leverage of the company and all these other factors that I think go into the price, which leads to these, let's call it, disconnects between what is stated on the financials as NAV relative to what the shares are trading at.
All right. And Estienne, that sort of leads me into the next thing, is just around the debt in general. Traditionally, it's made a lot of sense to have reasonably high levels of debt in the property sector. You've had fixed assets with, as you say, fixed term contracts, so reliable revenue. You've been able to have quite geared balance sheets across the industry, and that's historically supported the industry. And I suppose that there are probably two questions here. Firstly, Growthpoint's current level of debt, is that a concern for you at the moment, particularly given some of the mismatch between the currencies that your debt is in versus the currency that the asset's in some of your international businesses? And then secondly, do you see a change in the kind of levels of debt that you will have as your targets? If I understand correctly, your current target's around about 40% loan to value. Would that maybe in 5 years' time look a little bit different? If you could just give us some thoughts around that, please.
So look, I mean, I think the levels of debt being high or low is a very subjective thing. Okay, I think maybe the first point to make. So if you a private property investor, the level of 50% is bizarrely low, because generally you're running at gearing levels of 60 to 70. In fact, if the bank would give you 100, you'd probably take it, right? Because you're trying to optimize your return on equity. In the listed real estate space, the sort of accepted norm is in and around 40 is probably reasonably acceptable. And if it moves materially above that to say 50 and above, then it starts getting maybe unacceptable level, so 50 and above, whereas below that generally is acceptable. I think in the current environment, the one point to be made is if ever you wanted to have debt at a higher level, now is not the worst time, given the cost of interest being lower in this lower interest rate environment. But I think most of the real estate companies are looking at their balance sheets and thinking that, to the extent that there potentially could be still a further weakening in valuations, they'd probably be wanting to be a little bit more on the conservative side. And I think most real estate companies, including a Growthpoint, are looking at alternatives to maybe, reduce the debt levels. I think the other point to be made is in the BPR, which is the best practice recommendation that SA REIT recently released, which is the second version of their document, the way we calculate that loan to value ratio has also changed. It includes now the mark-to-market movements in, for instance, interest rate swaps. So if you out the market on your interest rates or out the market on your currencies, all these factors are actually built into your loan to value. So you're going to see loan to values maybe be a little bit more volatile than they have been historically. And I think that's important because in a Growthpoint scenario, it added an extra 2% to our LTV, So those things also have to be taken into account. So it's not quite apples with apples. I think if we think about, certainly those real estate companies that have global exposure, clearly those balance sheets are a little bit more complex. And I think, we dedicate a whole slide in our investor analyst presentation to kind of depict exactly what our loan to value is vis-a-vis the cost of the investment, and maybe where relevant the mark to market of the share price. Now we have two investments, one being Capital and Regional and the other being Global Worth, where you don't really have a liquid tradable market in the stock, because we have a very large, or there are a couple of shareholders that have a very large position. So there's no liquidity in the stock and the pricing isn't evident. Whereas, let's say, a Growthpoint Australia, I would argue that the market is a little bit more transparent in terms of the pricing there, and you can get kind of a scenario of exactly where it is. But I think the point to be made is that, we generally err on the conservative side, and I would argue that over the medium term that, it would be unlikely for us to add significant quantums of debt in terms of acquisitions or any other sort of transaction. So I think the view would be that, we're going to look at ways that we can probably nurse that number to keep it around the 40-odd%. And debt's not a bad thing, right? I mean, in real estate, if you've got income, if you've got yields, if you're buying assets with, let's say, yielding 10% and you can fund it at 8%, you're getting a 2% carry that goes straight to investors. That's enhancing, right? And the big thing is to ensure that that you have to be pragmatic and you have to be balanced in your approach and prepare for a 150-year event like we've just had. So what we have done over this period, we've ensured significant liquidity facilities. We sit with 3 to 3.5 billion rand of available facilities to ensure that if things don't go quite as harmonious as they should be, that we can at least see out a rainy day. But generally speaking, I think Growthpoint will be looking at ways to nurse down the LTV to around the 40-odd%.
In your opening comments, you mentioned that the market's factoring in capital raises for a lot of the South African real estate companies. Is that something that that you're thinking about at Growthpoint? Is it necessary?
Look, I mean, I think if you look at the ways that, let's say, a Growthpoint can reduce its, there's self-help ways. So in other words, we have been, over the past 3 years, we've sold over 7 billion rands worth of real estate into the market. Now, clearly in an environment where liquidity is a little bit tight, we still continue to sell. Interestingly enough, we're seeing quite decent liquidity on properties below the 50 million rand level. So we do have a bit of a section of assets that are smaller, often industrial, and owner-occupiers are buying those and private investors are buying those. And in fact, we're achieving values above our book value, which is quite comforting to come back to your valuation discussion. I think we really consider all the alternatives in getting to an answer, and it might include all sorts of things. You might have to sell some assets. We've got a initiative which looks at building a fund management business where you don't need to use that much of your own balance sheet capital. So that would be creating like our healthcare fund, where it's effectively third-party investors' money that we are managing in real estate and providing them a return on that. So we're using all our same skill sets, all our same processes within the business, whether it's property administration, development, or the asset management side, and we basically using those skill sets and generating additional return on that. So that's a mechanism to also relieve some pressure on the balance sheet and on the cash flow. And then, yes, you have to probably put equity into the mix to say, maybe equity could be another way if you add it in a reasonable way, to bring that into the mix. I think the reality is I think many investors are looking back to the GFC, where some of the Australian real estate companies did, massively deep discounted rights issues, but not, like 4 shares for every one, So it really diluted investors out of sight. And I mean, we were a beneficiary of that. I mean, our business in Australia that we acquired at the time, had a market cap of, say, $40-odd million. I mean, we put 200 million into that company, and investors, were diluted. The investor that originally went into GOZ were the equivalent of $10, and we recapitalized the company at $1.60. And over the years, that was been probably one of our best performing assets. But it was very much on when we got in and how that investment has grown. And even today, the share price at about 350. So if you came in at 10, you were still, deeply discounted from that point of view. And I think that's what investors are scared of. But certainly the way we think about it, we don't foresee that kind of behavior coming out of the sector, to be honest.
All right. A last one from me, Estienne, is, typically investors will invest in property companies for the income, for the dividends. Now, that has been growing traditionally, as Alvan showed you on some of the slides earlier. The dividend situation or certainly has stopped growing for now. One of the things we've seen over the last, say, 7 or 8 years is an increase in financial engineering and a lot of companies paying out very close to 100% of distributable earnings, whereas your REIT status only requires 75%. Can you maybe just give us some thoughts on how you think that progresses? Do we sort of see the industry maybe going back towards paying out only 75%, using some of that money that they keep to then also help sort of nurse their balance sheets back to health? Last one from me, thank you.
Yeah, so maybe just a bit of background on that. I mean, I was quite involved in the actual REIT dispensation with National Treasury, and I think maybe, looking back, one of the balls we probably dropped was to provide maybe for REITs to withhold distribution without incurring taxation. So to the extent that a REIT can pay out less, so let's say 25% less, but whatever they withhold, they pay tax on. So you effectively get 70% of whatever you've withheld, you can retain. I think in the environment that we were in at the time when we put that legislation in place, valuations were increasing, and generally what the behavior was to say, look, guys will pay out all their free profit to investors, and that was the model. And to the extent that they have capital expenses, they either went and raised capital to do that from their investors, or they would raise debt. Now, clearly in this environment, that kind of behavior is probably not sustainable, given the fact that I don't think there's that much supply of cash from investors, and also from the debt perspective, the industry doesn't really want to raise their debt levels in this environment materially. So I do think that the retention of capital is a way to strengthen the balance sheet, but it's also a way to ensure sustainability of the company. And it speaks to the capital requirement of the assets. So to stay in business, you need to upgrade your shopping centers, you need to refurb the offices that are maybe now towards the end of their life cycle, or if the tenant's moved out and a new guy moves in, you need to give the office a bit of Botox and a nice fit out. And those are all things that need to happen in the ordinary course. And in industrial, it's got a similar theme. So maintaining a running business, like any other business, you have to reinvest into it, and that takes capital, and that's what is happening practically. So I think in this environment, I think distributions, most executives and boards have had to be conservative. If you don't know that you're going to get all your rental, and maybe tomorrow your whole business is closed down by government, the natural reaction from any board is to err on the conservative side. So I do think if things normalize, which they will probably over time, that the behavior of paying out a reasonable level of distribution will be the order of the day, and that's the way the REIT model is designed. It's effectively the cheapest and most liquid way to get real estate exposure. So if your investor is sitting there and he wants to get real estate exposure, typically the guy's thought about, let me buy my flat out at the sea, and unfortunately, an asset is something that generates income. Right now, a flat at the sea generally doesn't do that. It normally takes income. And that's why the definition isn't quite consistent. But if you look at REITs, they generally have paid distributions. And even today, in this difficult time, Growthpoint has paid its investors a distribution. We paid an interim distribution, and we will pay a final distribution. And I do think that most of the people in the sector will pay at least the 75%, because otherwise they're into regulatory difficulties. I think what we will try and do from a sector perspective is maybe try and negotiate a small component, be it 5 to 10%, maybe 10% that REITs can withhold for maintenance capex. Because in this environment, I do believe it is important that those REITs retain some of that capital to be able to reinvest it into their properties. But I do think that over the medium term, that the behavior of paying distributions to our investors is important, because for the investor, the nice thing about a REIT is that you have quite typically very good transparency on what your income return is going to be. So you can say, I'm buying this thing, it's going to be a 10% yield, and then the capital growth is a little bit of a bonus, right? And generally that comes, and we have seen, you know, if we look at that graph that you showed earlier, Alvain, on the historic dividends, the growth of the actual underlying capital, you know, what happened was not only was there a re-rating in the actual sector. So in other words, I mean, in the 2002, the whole sector was 5 billion rand total market cap. Now, that's not really a liquid and tradable sector. Whereas if at some point the sector was close to 600 billion rand market cap, made up nearly 5% of the listed sector's exposure, or the listed market exposure. And I think what one would have seen in those times, the whole sector re-rated because there's a price for liquidity, right? That makes sense. But I think what also happened is the yield environment globally has come down significantly, and in fact structurally so. And we don't see that reversing in the short term, to be honest, given where the global economy is with all the kind of challenges that we're having around COVID at the moment, and what governments have done. They've been issuing a lot of liquidity into the markets. We foresee actually the interest rate environment remaining reasonably low for longer. So that will be supportive of real estate, I think, over the long term.
Estienne, can I ask you a question before I go to the clients' questions? Can you just explain to the clients and to us, when COVID struck, the dynamics that you had between yourselves, your clients, and of course you were clients of the banks? If you can just take us through the dynamics, what has happened on the ground when people simply couldn't pay or could pay but claimed that they couldn't pay?
So it was, I mean, it was absolutely terrifying experience to live through that, and hopefully we never go there again, because I don't think our economy can afford it. But what actually happened was, in fact, Growthpoint had just released its results, and the next weekend and announced our dividend, so we were committed, and we then got the state of disaster announced, right? Very shortly after that, the banks started calling me to say, look, you know, there's a couple of headwinds coming your way. And I mean, talking top executives at the banks. So they immediately saw the challenges. And we when lockdown was announced, immediately some of the retailers had already kind of sent letters to say, look, you know, we're probably not going to be paying our rental. What did we do? We pulled together the whole industry, SA REIT, Shopping Centre Council, and SAPOA members. So these are private, institutional, and the listed sector. We got Competition Commission approval, got together, discussed this challenge, okay, because it was a challenge, and identified all the areas where we saw risk. So we engaged BASA, which is the Banking Association, the CEOs of the banks. We started discussing maybe a little bit of relief or a softer touch from the banks, because they could destabilize the sector if they start pulling in all the covenants, and you know, that wouldn't have been very good for South Africa. With regards to the specific retailers, I think the sector very quickly agreed to a guideline for relief, and I think we pumped close to 10 billion rands worth of liquidity into the South African business sector, which is probably the most effective liquidity package, but it came at a cost for the sector. But it basically, you know, recognized our symbiotic relationship that we have with our clients. And most of this went to the retail sector, albeit that it's also rolled into office and industrial to some extent. But, you know, the smaller retailers, the little coffee shops, the hairdressers, you know, all these kind of retailers, they're very reliant on their trade from a month-to-month point of view. And ultimately, we had to provide them relief in this period. So for a 3-month period, there was mainly discounts. And then after that, the sector's probably been giving deferrals and rental and pushing that out on a sort of a zero interest rate basis into the sector. And that played out across the sector. I think what was effective in that process was the fact that we avoided litigation. So if you look internationally, Australia, the UK, and America, the retailers and the landlords are at absolute war in terms of their relationship, and that's not really constructive. So I think what has happened is, I think we've probably improved relationships with our clients through this period. But it's no doubt, we've all suffered significant pain, and that can be seen in most of the results. So other than the pharmaceutical sort of providers, most of the retailers have seen pain. And we've covered the bond market, we covered the banks, we looked at the regulators. I mean, we spoke to the regulators for maybe some relief on the payout ratio. We even spoke to National Treasury to see if we could get some relief on the tax to the extent we withheld. Unfortunately, we didn't get much joy there, and that is still maybe a bit of a bone in contention, but it is what it is. And I think the sector is sort of emerging out of that now, and all we can hope is that we don't go back into kind of a second phase lockdown, which South Africa can ill afford. If you just look at the impact on the economy, it's been the most extreme globally.
Yeah. There were a number of questions that relate to, I think, some of the stuff that Dave asked you. This is just not a normal cycle. So some of the things that we got used to, we used to think that they're just cyclical, and then at some point the cycle will recover. So many of the questions refer to the fact, don't you think that there's been a fundamental change in the property environment going forward? And the one question referred to office space. And related to that, if that is the case, and warehousing is one of the things that, the fundamentals still look okay. What are you doing locally in terms of warehousing? So maybe just cycle versus structural or fundamental, and then other areas. And I think you touched on one or two, but maybe answering the question of warehousing in particular.
Yeah, so I mean, I think the first sort of tailwind or positive that the industrial, specifically logistics space, has seen is that similar to the rest of the world, we import pretty much everything, and very little is being produced in South Africa. So that drives logistics. I think secondly, there's been technological improvements in logistics, and albeit that we haven't seen massive growth in logistics in South Africa, we've seen a wielding out of old space into newer space. And that's been driving a development sort of activity. And we've been very active as Growthpoint developing, real estate in the industrial space and specifically logistics. I don't see that continuing if you have a continually weakening economy, because there is a correlation between retail and industrial and the movement of goods, So to the extent goods aren't moving, okay, they might have to be stored, but people stop importing them at some point, right? So, I do think that there has to be a correlation, and I think that will play out over time. And I do think from an investment perspective, sometimes I do struggle, to see the upside in something that's priced significantly above its replacement cost, and how does that play out over time if you're thinking about a total return kind of answer as an investor. When we look at the other sectors, I mean, there's no doubt office it's not clear as to exactly how that will play out in the future, but I can only speak from my personal experience in having worked, kind of financial sector and having to work from home. And it is not necessarily, if you're running an operating business, and I think that's maybe an important point. If you're an asset manager, and these are the guys that are making most of the comments, that's very different for them. If they don't like it, they can just sell it, okay, and then they buy something else the next day. Whereas if you're running an operating business, you have to work with people. You've got processes, you've got operations that you have to run, and that's quite difficult to do it remotely. And to make sure that your staff are motivated and continue to have a high level of productivity. We do see over time that people will wheel back, but there's going to be a requirement for more flexibility and more amenities in the office. That's no doubt.
Okay. I know that we are running out of time, but I find it so interesting. So some of our clients that feel that they've got to go for their cycle or their run or their glass of wine. Pour yourself a glass of wine and come and join us again. But I want to, maybe the second last question, there's been one or two questions on offshore property in general, but then also, your experience, Growthpoint's experience in terms of the investments that they've made offshore. Now, forget about the currency for a South African investor. So, on a standalone basis.
The fundamentals.
Yeah. Can you just
so let's quickly run through them. So we've got 3 international investments. The first one we made was Growthpoint Properties Australia, where we recapitalized a small vehicle that owned 26 properties. The valuations of those properties was about $650 million at the time, Aussie dollars. I mean, the currency at anecdotally, we went in at 640 to the rand. It's now close to 11.50 or something. We recapitalized at $1.60. The share price has been as high as 440, is currently at about 350. That investment has kicked off a yield of in excess of 11-12%, growing at 4% for us for a 10-year period. The best investment I think we've ever made. So that's the unicorn. Okay, so that's the extreme. Then the other opposite is our most recent experience, okay, which is we made a very tiny investment. We took control of a little vehicle in the UK, owned 7 properties. They are retail properties, but needs-based. So the butcher, the baker, the candlestick maker, and we saw we thought that would be a very resilient area of retail to invest in, and that the moms and pops in the UK in these areas in London will continue to shop there. Now, on paper, that's a great idea, and we put in about 3 billion rands worth of equity into that. And what we have seen, unfortunately, is COVID has had a massive impact there. So we've seen the equity pretty much wiped out, if the market's to be believed, and big pressure on valuations. And as I said, there you've got a government-supported rental strike, okay? So the landlords aren't allowed to touch the retailers, and whether the best trading retailer there, you just by choice don't pay. Now that clearly isn't sustainable, and I think hopefully over time that will correct, and we will start seeing the returns that we hope from that vehicle, but we'll have to do something in the short term. And then the medium, the one in the middle would be Global Worth, which is Eastern Europe. Now, the Eastern European economies have been the best performing economies on the globe for some time, because they've got a lot of stimulus support from the euro, and these are very sophisticated, well-educated population groups. Places like Poland have grown significantly, and what we have seen is that that market fundamentally supported good real estate activity. And we've gone in there. There are now 3 very large shareholders in. So other guys also saw the gap, okay, and bought into this vehicle, which is obviously a nice tap on the shoulder for what we saw first. But the reality is now you've got a vehicle there with 3 big shareholders, and we're going to have to work out how we take it forward. But actually the underlying real estate, both in Australia and in Eastern Europe, has performed very, very well and been good to us.
There's a very clever question, or somebody that says, how long...
Property guys aren't so clever.
No. We'll tell you a story about that later on. How long do you expect the current cycle of negative rent reversions to continue until the base has been reset? So polish your crystal ball there again.
Yeah, so I mean, I think each one of the sectors has got a different dynamic. To a large extent, there is a function of inflation that comes through in the underlying development. That sort of kind of gives you the first base. So, if you're bringing on new quality office, you can't do it for under 230 rand a square meter kind of thing, on gross sort of rentals. Now, what we have seen is over the past 5 years, actually systematically there's been weakness in rentals, and actually the rentals have come down quite significantly over time. And unfortunately, the correlation is directly to the economy. So until you don't see the economy turn, I don't think you'll see a strengthening in rentals, because at this stage there is significantly surplus supply now. I think national vacancies are pushing 14 to 15%. And I mean, even Growthpoint, we've got a meager 258,000 square meters as at year end of vacant space. And some of that is swivel space. So in other words, we're busy refurbing properties with tenants pre-signed. But the reality is it's a little bit like a bucket with a hole in at the moment. So, very competitive market. And until the economy doesn't turn, I think we're probably up against that a little bit.
Because there were a number of questions about the sustainability, and I think those questions, to my mind, relates exactly to that kind of thing. You know, if South Africa is, if we're never going to see economic cycle again, then
sure.
you know, then you don't want to invest here, you don't want to invest in a bank, you don't want
Correct.
to invest in anything in South Africa.
Correct. And
quite
unfortunately,
frankly.
that's what's been happening.
Yeah.
I mean, the real estate has sort of indicated with the activity globally and maybe the lack of investment locally. I think Growthpoint's been some of the few companies that continue to sort of invest in real estate and develop, etc. So, you know, we're hoping that that will turn. And I mean, we've got a great country. There's a few really good things about it. We've got clever people. We've got the ability. There's a workforce. There's a willingness. And I do believe that, you know, hopefully if we can just change a couple of mindsets, hopefully things will turn, you know. And certainly behind the scenes, we're working on hopefully adjusting some of those things, you know.
The final question is, how would you respond to your mum if she told you that she is keen on buying listed property shares?
Yeah, and this
So I
is
think that
quite
is the bottom line.
It's quite close to home because my mum has long listed property shares and bought it maybe higher than the 25 sort of level, and currently Growthpoint's at 11. So I'm walking a little bit careful around mom's house at the moment. The reality is, I think maybe just quickly touch on REITs. So REITs, all it stands for is Real Estate Investment Trusts. It's sort of the Omo of washing powder, the name. And all it means is it's a vehicle that's got a tax dispensation which provides flow through. So it's like holding actual real estate, the underlying real estate. We pay out all the profit every 6 months. So that's the model, and it's tax efficient in that we don't pay capital gains tax if we sell properties. So it's an efficient way, and as I mentioned, the most cheap and liquid way to own. In fact, you don't even pay stamp duty when you buy the shares. So that's how cheap we've managed to negotiate with our National Treasury. If we look at listed property today and when I would buy it, I mean, there is no doubt there's uncertainty, right? And I don't know where the economy is going to go. And clearly, if the current policies are continued to be followed at government level, I think we have continued problems. If there's a change in some of those policies, and obviously maybe a bit of austerity in some of the approaches and investment into infrastructure and those things start happening, and maybe privatization. I know that's a big swear word in this country, but I do see that if your airlines, your utilities, even water, internationally, those things have been privatized. And I believe that that can be strong growth drivers for this economy. And I think on that basis, you know, I would argue it's not a bad bet to maybe put a couple in mom's box, because the one thing is certain, she might not have got the same distribution from Growthpoint she got last year, but she will be getting distributions. And relative to maybe some of the stuff, you know, because obviously in her cash portfolio, she's getting half the interest that she got, you know. So I do believe that, you know, there's probably some upside there, and over the long term, I believe that could be quite generous, actually.
Estienne, thank you very much. It was really a pleasure having you here. Thank you, Dave, for the questions that you've posted and provided a bigger dimension to the discussion. And to all our clients that joined us and the intermediaries that joined us this afternoon, thank you very much for your attendance, for the smart questions that you've asked. And hopefully you can understand sometimes the dilemma that we sit with, where we often focus on price. And if you focus on price, more often than not, you might be contrarian to start off. But over time, my experience is that is often your best margin of safety, not to overpay for an asset. And I think property is probably in that category now. Thank you very much for your attendance.